All right, guys, welcome back. Joe here from 9 to 5ers, and we're going to talk about something that's a little bit off the wall and is going to be maybe a new concept. Maybe it's going to be something that you may have heard of and you just don't understand, or maybe this is a completely brand new concept that you've never, ever heard of before. And hopefully it's something that we can, educate you on and maybe spin in another direction. And this is going to be a HELOC versus a mortgage. And just a quick disclosure here, guys, please use the following information for educational purposes only. We are not lawyers, certified public accountants, or financial advisors. Please seek professional advice on an as-needed basis. Thank you so much. So the overview, it's kind of a long one. This is going to be a two-part video, guys. So this is the first one, and then we will follow up with a second one to break this up a little bit so that it's easier to watch. We're going to talk about what a HELOC is. We're going to explain it. And then we're going to talk about the traditional use of a HELOC and how it can be used a little bit differently. And with it being used differently, we're going to compare it to a mortgage, a HELOC to the mortgage. And it's going to be a pros and cons list of a HELOC, because I like to be 100% transparent. I like everybody to know all the different angles that they are taking and knowing the risk, at least most of the risk going into it. And like I said, I'm not a salesman on this. I use it personally and I'm a proponent for it, but I also want everybody to know this is definitely not for everybody. So that leads into who does this work for and who does it not work for? Questions you want to ask yourself before you move forward, how to kind of create a basic plan of action if you decide to move forward. And we can talk about some what ifs and some frequently asked questions near the end here. And a bonus is going to be kind of thinking outside the box of how you can take this tool and turn it into a power tool for debt weapons or creating wealth. So without further ado, guys, let's just jump right into it. So what is a HELOC? Well, a HELOC is a home equity line of credit, like we've already said. And it's a loan in which the lender agrees to lend a maximum amount within an agreed period, where the collateral is the borrower's equity in their house. So let's just take a quick example here. You say you have a house and your house is worth $100,000. You owe the bank $25,000 on it still, on your mortgage. The bank will lend. The bank says, hey, Mr. Borrower, we're willing to lend up to 80% of your home's value, which is $100,000. And you're like, oh, great. So how does that work out for you? Well, you take your home value, which is $100,000. You multiply it times 80%. That's going to give you $80,000. You subtract the debt that you also own on it, that you still owe on it, and you have a HELOC limit available to you of $55,000. Now, just so we're clear, we're subtracting the debt. That doesn't mean we're erasing the debt, okay? That just means that you have $55,000 that you could pull out in addition to the what you owe on your original first mortgage there. So just continue there. There's the definition up there again. Sometimes HELOCs are called second mortgages, and that's generally where they are put, is a second mortgage. So I'll give you a stereotypical example. You got your $100,000 house, you owe $25,000 on it, and you're like, man, I really love to put like a new back deck on this house, and that new back deck is going to cost me 20 grand. I really want to do it real nice, and I want to add value to this house. And you're like, and so you go to the bank and you're like, hey, I want $20,000. And a lot of times what they will do is they can give you a second mortgage, which is not a HELOC. They basically just add on a second mortgage, which is an additional payment. And you make two payments every single month to the lender. Or you can do what's called a HELOC. And a HELOC is the home equity line of credit. You would pull out, say, the 20 grand that you need for the rehab or for the deck that you're trying to put on there. And then you would pay that back in interest only payments. And it would be up to you to make additional payments above the interest to pay off that loan. And a traditional second mortgage would be principal and interest payments. And there's a lot of banks out there that they're using a term or a phrase called a HE loan. I don't know what that is. I don't know if it's just like marketing jargon or if it's an actual term, but just so that you're aware, a HE loan and a HELOC are not the same thing. When we're talking about this and all the pros and cons, we're talking about a HELOC, not a HE loan. So a mortgage versus a HELOC. Now, we're going to get into this, and we're comparing a mortgage versus a HELOC that is in a first position. So I'll say that again. A HELOC that is in the first position. So in other words, you don't have a mortgage. You only have a HELOC on your property. A lot of people don't realize that you can do that, but there are banks out there that are willing to do that. Banks, credit unions are allowing you to put a HELOC into first position and replacing it with your mortgage instead of having a mortgage. So when we're comparing these two things, and just remember that we are talking about a first position mortgage versus a first position HELOC. And if you have one, you don't have the other in any second position whatsoever. So just that's a kind of a radical concept, and I kind of brushed over it there, but I want to make sure you understand that you can have a first position HELOC that replaces your mortgage. So a mortgage here, we're just explaining the two, how they differ from each other. The money goes in one direction. It's a closed-end loan. So basically what that is, the money goes from you to the bank, and that's it. And the bank doesn't send you any money back. It's PITI, so that's principal, interest, taxes, and insurance. That's generally what a mortgage payment is. If you have a mortgage payment, you're basically probably set up like this. It's principal, interest, taxes, and insurance. There are different setups, but for simplicity's sake, it's principal, interest, taxes, and insurance. You have a fixed rate of interest usually, or sometimes you have what's called an ARM. So a fixed rate is you're locked in at 5%, 6%, 7%, 4%, whatever it is. And that's your rate that you pay for the life of the loan. Or you have what's called an ARM. And ARMs are a little bit more attractive because they kind of entice you in with a lower interest rate initially. And an ARM stands for basically an adjustable rate mortgage. I'll give you an example. If you had, let's say, a 30-year loan, and it adjusts every 5 years. So from year 1 to year 5, you would have an interest rate. And then on that 5th year, it would adjust. It would either go up or it would go down, or it would stay the same. And then every 5 years, it would adjust up or down, or stay in the same spot. That's what an ARM is called. And we're not really going to be talking about that too much, but I wanted to at least explain it here so that you guys have some background knowledge. Your balance goes down over time. That's basically it. You make your payments, the balance goes down, 20 years go by, 30 years goes by, and you've paid it off completely. You pay off your house on the bank's terms. And if you've ever looked at an amortization table or anything that when the bank has to show it to you, you've actually looked at it and sat down, you're basically buying a house for yourself and you're buying a house for the bank when it comes to the numbers, because you're almost going to pay double for your house if you get a 30-year mortgage. And that is based off of interest. Yeah, interest does affect a little bit, but you're basically paying double. So let's look at a HELOC. Money goes in two directions. It's called an open-ended mortgage. The money can go to you to the bank, or it can come out of the bank and back to you. It's like a checking account. And your checking account, you put money in, it can come out, and the bank just kind of facilitates. It's just a place where that money can sit. That's basically what a HELOC is. And the difference between a checking account and a HELOC is that if you pull, you're always paying interest, and you're paying interest based off of the balance. But I'm getting a little bit ahead of myself here, but just look for this bullet point here specifically. The money can go in two different directions. It can go in by you making payments, or it can come out either way. Interest payments only. So if we're going back and forth here from left to right, we're kind of doing a compare and contrast. On the left side, you got principal, interest, taxes, and insurance. A HELOC payment is interest only payments. So you're going to have out of that PITI, you would only be paying the first I there. It's up to you to pay the principal over and above and beyond your interest payments. It's up to you to pay your taxes on time when you're supposed to. It's up to you to pay your insurance on time when you're supposed to. So you have to be a little bit better at managing your money versus someone that just pays a mortgage, because as taxes come, the insurance payment comes, and you have to be able to make those payments, and you have to be kind of prepared for them. So you're required just to make interest payments only on this one. And if you don't pay off if you only make interest payments only, then you'll never pay off your house and you'll never pay down the balance. So just an FYI there. Variable rates. Now, this is where a lot of people get scared because it's a variable rates. What if it goes from 3% up to 30%? What am I supposed to do? This number can be tracked, and the bank should disclose it to you how they calculate your interest rate. And we're going to get into that a little bit later on how you can track that and how you can kind of plan for that and attack that. But you generally have a variable interest rate. There are fixed rates on HELOCs, and that's up to you whether or not you want to get the fixed rate or the variable rate. Generally, the variable rate is lower because you are taking on the risk of volatility. And a fixed rate is you're taking the safety aspect of it, but if you're looking at both interest rates on the same day, the fixed rate is going to be higher. Your balance can go up or down, just like a checking account. If you pull money out, your balance goes up, the amount that you owe to the bank. And if you put a bunch of money in, then it goes down. So it's different than a mortgage. And that's what makes it open-ended. The balance can go up, it can go down. And you are paying off your house on your terms. And I'm going to explain that a little bit later on, but just kind of remember that concept there before while we move forward. So let's just compare here really quickly. Why would the HELOC seems way more complicated. Why would I want to do that? Like, besides the fact that I can pull money in and out, like why wouldn't I just have a mortgage and, keep a checking account, and I don't want to risk my home. That doesn't make any sense to me. Well, this slide right here, as we go through it, will be the key difference of why most people will take a first position HELOC versus a first position mortgage. And we're going to do this based off of a generic case study here, as you can see. So $100,000 house, we got a loan, and it's 5% interest rate. We put 20% down, and it's a 30-year term. Basically, same as the last one. Your mortgage for that house, just principal and interest only, is going to be $429 per month. Your first payment is going to be $429, like we said. 96 of that is going to go towards your principal, and $333 is going to go towards interest. If you look at an amortization table, a very, very, very long portion of the loan, you are paying more interest than principal. You are paying the bank the luxury of owning that, getting that loan, and the bank gets paid first. So your balance goes down to $79,904. Wow. After 7 years, where are we at? Well, we're not much better. We're up to now $136 going to the principal, and $294 is now still being torched away in interest payments. You're now at $70,356. In 7 years, you've only paid off a little over $9,000. That's pretty terrible. You've basically paid mostly interest this entire time. Okay, we're at the halfway point. Thank God. Well, guess what, guys? You're still paying more in interest than you are in principal. Now, remember, your payment is still $429, still the same amount, but you're still paying a bigger percentage in interest than you are in principal for the first 15 years. And you can tell that for the 30-year loan, the majority of that time, we're going to be paying more in interest than we are in principal. 25 years. Now, I picked this randomly and I actually got lucky. If you look at the 25-year payment versus the first payment, we finally flipped completely. It took 25 years to flip around, and we still owe $22,756 left. And you might be thinking to yourself, how the heck are we going to pay this off in 5 years? There's no way, because from year 1 to 7, we only paid off $9,000. Well, $9,000 here isn't going to get us there. Well, we're finally paying more in principal than we are in interest, and that will get paid down to zero. It's set up that way. But just take a look at this for a second and look how much you're giving to the bank for the privilege of buying a house from them. Some people say it's fair. Some people say it's not. I say it's not. So you are locked into their math. They've set this up to where if you get a mortgage from any, this is how all mortgages are too, by the way. If you get a mortgage with a bank and you, let's say you move in the first 7 years, 10 years, 15 years, the bank is happy because you're going to sell it to somebody else and they're going to start the whole process over again. So you can see why by the time you get down to year 30, you've bought a house for yourself and you bought a house for the bank, and the bank appreciates that. So let's look at the difference here. Why would we want to use a HELOC? Well, I cannot give you a table like I did here on the left, and there's a reason for that, is because the interest that you pay that month is based on the daily average balance that you owe. So what does that mean? That means that if you look over here on year 7, let's say that your daily balance on your HELOC is $70,356. Okay, well then your interest only payment is going to be roughly $294. And if you're down in the $22,756 category, your interest payment is going to be around $96. And you're probably thinking to yourself, well, okay, yep, I get it. It's my interest payment fluctuates just like it would for a mortgage. So why would I get a HELOC? I'm still not getting it. Okay, well, let's keep going here. So generally, if a person is, financially, they're diligent about their money, they're disciplined, and they're doing what they're supposed to be doing. Let's say you got $5,000 in your checking account and you got $5,000 in your savings account. Okay. What if you took that $5,000 here and that $5,000 for your savings and you just put it all on your HELOC? So you dropped it from 79 down to 70. And instead of paying $333 in interest, you only pay $294. Now you're thinking to yourself, that's not really a lot of money, Joe. That's $37. That's not even a dinner out for two. Why does that matter? That still doesn't seem like it's making me any money. $37. Well, you're right. $37 isn't a lot of money. That's what you saved on your first payment. Right. But the key takeaway, guys, is this. You've taken back 7 years worth of interest. Don't look at it as I only saved $37. You wiped out 7 years worth of interest. And I calculated this up from year 1 to year 7. You pay $27,765 in interest. So it's not $37 that you say. Yeah, you saved $37. Awesome. On like today, you saved $37 today. Great. But you wiped out 7 years worth of interest. And that equates to $27,765. So basically, you paid somebody, if you paid If you loan me $5,000 or $10,000 and I paid you back $27,765, would you take that offer? Yeah, you would. That's a great deal. You're wiping out years and years and years of debt. The key to this is the fact that you are wiping off years and years and years of interest payments. It's not that it's going from $333 of interest down to $294. That's nice. But if you can wipe out 7 years right off the bat, then let's do that. And you might be thinking to yourself, well, I need $5,000 in my checking account to pay my bills. I need $5,000 in my savings account for the what ifs of what could happen. Okay, yes. But remember, let's go back a slide here. Money goes in two directions. It's open-ended. If you put that $5,000 in, you can pull that $5,000 back out if you need it. But if you don't need it, then it sits in there and works for you. That's the point. That is the point of this. You can pay off a mortgage, a 30-year mortgage in 5, 7, or 10 years, or a combination of some in that time, because you are wiping out that interest. You're getting closer to that 25-year payment much faster. So I want to be, what's the pros and cons of a HELOC? You know, we saw that I can wipe out thousands and thousands and thousands of dollars worth of debt, you know, making my first payment there. Well, there are some more pros here. There's cheaper closing costs or no closing costs. Depending on where you do this, which state you're in, it's generally cheaper to create a first position HELOC than it is to create a mortgage, because in a mortgage, everybody's got to get their cut. Everybody's got to stick their hand in there and get their cut, whether it's Fannie Mae, Freddie Mac, or the VA loan, FHA loan, a HUD loan. Everybody's got to stick their hand in there and take a cut at the closing cost at the closing table. They want to get paid right now. Versus a first position HELOC, which is almost entirely done in-house by that bank. So they don't have to pay anybody else out, so they can pass those savings on to you. So it's cheaper to close. Back and forth flow of funds. Flexibility. You put in your $10,000, okay? And you got to pay your electric bill. All right, well then pull out $120 to pay your electric bill or whatever it is and pay that electric bill. You still have $4,800. I'm missing it now. You still have, out of the $10,000, you're only missing $120. That's nothing. You're still getting the vast majority of that. And yes, you have to pay your bills outside of it, but the vast majority, it's not lazy money that's sitting in your checking account or in your savings account, not making you any money. So just remember that. If you put in $10,000 and you have to pull a couple hundred out to pay your bills or what have you, you still have the vast majority of your money in there working for you. Minimum payment options. So let's say that you have a bad month and your car breaks down and you can't put in your entire check into the HELOC. Okay. Well, with a mortgage payment, you have to put in that $429. With your HELOC, you have to put in whatever the minimum interest is. And if you're still at the beginning of your loan, then you're closer to the $333. If you're near the end of your loan, it's like $96. But it isn't $429. So if things don't go perfectly every single month, which they never do, you're not thinking about, oh, should I make my mortgage payment or should I eat? It's, I can make the minimum payment this month, I can get back on track next month and move forward. Focused debt attack. When you are throwing all of your money, all of your excess cash into that HELOC, you are attacking it from all ends and you can get that paid down so much faster. That's how you can get it done in 5 years, 7 years, 8 years, 9 years versus 30 years. Because as you saw, the first 15 years, the majority of it's interest. No PMI, no private mortgage insurance because there's no mortgage. And you can refinance this back into a mortgage if needed. So if the HELOC's not working out for you and it's just not right for you, you can always go back and refinance it to a mortgage and do that. So the cons, there's not very many cons, but the few that there are, they are huge. And that is, people just don't follow through with it. They get that HELOC and they look online and they see, man, I got $45,000 in there. I got in my in my quote unquote bank account. What should I do? I could go buy a bass boat, or I can go on 3 or 4 vacations, or I can go put a down payment on a sports car. Then you're not helping yourself. You're basically just shooting yourself in the foot. If anybody fails at this, it's generally this first one right here. People just don't follow through. They don't have the discipline to focus all of their cash on that debt and knock out that mortgage or that HELOC. People lack discipline. I've already said this. They get loose with their money. They think, man, I got 50 grand in the account. What's $5? What's $10? Well, what is it? I mean, $5 here, $10 here adds up to thousands and thousands of dollars of interest down the road. And listen, there's not a lifestyle difference between someone that has a mortgage and someone that has a HELOC. You should be living the same life. The only difference is that the mortgage person doesn't have access to 50 grand in their quote unquote checking account and their HELOC. The HELOC person does. So can you be a kid in a candy store and not buy any candy? That's the question. Other cons will be addressed later. So guys, this is part 1. Let me know what your thoughts were. Did we answer all your questions? Is there anything that has stopped you in the past from reaching your financial goals? What types of videos would you like to see next? And please like, comment, and subscribe. That helps out the channels. And if you're on Facebook, check us out at 9to5ers. Thank you so much. Have a good day. We're here to make you smarter today and richer tomorrow. Thank you.